Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, July 7th, 2023. This morning's jobs report for June suggests that the labor market may be cooling off a bit. Although the unemployment rate fell slightly to 3.6%, the number of new jobs added to the economy, which was 209,000, was also lower than the estimate for 225,000. Average hourly earnings rose 0.4% in June versus an estimate of 0.3%. And here's a copy of the news release from the Bureau of Labor Statistics. And if you've never been to their site, there's a lot of interesting stuff to see there. And their URL is basically bls.gov. So here's today's report. You can see the unemployment rate since June of 2021 over the past 2 years coming down from nearly 6% to a little over 3.5%. At the same time, you can see non-farm payroll employment over the month change. And yeah, of course, as more jobs get added, that leaves fewer and more jobs to be added later. But nevertheless, today's number was a little bit less than what was expected. So on the whole, that was considered positive news for the stock market. And it did react positively to that news, regaining most of yesterday's loss by this afternoon. So here's the past 5 days of the S&P 500. And you can see that big drop off yesterday, which essentially was a result of, in response to some comments by Jerome Powell about the expectation future rate cuts. But today's kind of made up most of that, not all of it. Maybe by 4 o'clock this afternoon, that'll be the case. But we won't really know how most of the portfolio managers on Wall Street will react to this news, since many of them are on vacation this week. Once they get back to their desks next week and really sit down and take a look at it, give us a better idea. My guess is they will view it as not being substantial enough to dissuade the Fed from raising interest rates when it meets next in 3 weeks. Not only is the data close to what was expected, but it's not unusual for the data to be revised upward or downward when the following month's report is issued. For example, and I'm going to go back to the report for today, and I'm going to scroll down near the bottom, and you get all the way down here, and you'll see this paragraph here. The change in total non-farm payroll employment for April was revised down by 77,000 jobs, from plus 294,000 to plus 217,000. And the change for May was revised down by 33,000, from plus 339,000 to plus 306,000. With those revisions, employment in April and May combined is 110,000 lower than previously reported. Some analysts believe the methodology used by the Bureau of Labor Statistics to collect this data is skewed to overstate the number of new jobs added to the economy when the initial report comes out. For that reason, they are assuming that today's report will also be revised downward next month. If that proves true, then there should be less pressure on the Fed to raise rates again in September. Even if that does not turn out to be the case, the Fed is looking at a lot more numbers than just the jobs report. On July 27th, we will get the advance estimate for gross domestic product for the second quarter. By then, we'll also know how the Q2 results look for a lot of companies, along with their updated guidance for the remainder of this year. That is why I continue to believe that the stock market will remain in a holding pattern until we see those numbers. Had today's jobs report been significantly different from what was expected, then that could have pushed the stock market out of its trading range. All it really did was offset yesterday's overreaction to the comments made by Fed Chair Jerome Powell. The next big date on the calendar is next Wednesday, July 12th, when the BLS will release the Consumer Price Index numbers for June. I see no reason to believe that it'll be markedly different from the 0.4% monthly increase widely anticipated on Wall Street. That works out to an annualized growth rate of roughly 5%, which is more than double the Fed's target rate of 2%. As long as that remains the case, we can expect to see at least 1 or 2 more rate hikes by the Fed. That's this week's PF video update, and I look forward to talking to you next week. Thank you.